welcome back to our three-part series entitled Popular Tools Used by the Market to Forecast Henry Hub Prices. And today marks the final installment of this series. In part one, I discussed various third-party price forecasts. Part two focused on popular technical indicators. And today I conclude this series by quickly reviewing publicly available information to discern clues about possible market sentiment. So as I mentioned on those other two podcasts, this series is meant for a general audience, especially for those who may be new to the U.S. natural gas market. And I apologize in advance if this may be a bit too rudimentary for some of you. This is also not meant to be any sort of price forecast or trading advice on our part, but rather an informational series. Okay, the two things I'm going to be talking about today are the commitment of traders report and options prices. So let's start with the commitment of traders report. As for what it is, let me frame things this way. In the equities market, you can see what U.S. stock investment gurus are buying and selling via their quarterly 13F filings with the U.S. Securities and Exchange Commission. Want to know what stocks Warren Buffett and other experts are buying and selling so you can piggyback on that? Look at their 13F filings. Or more concisely, take a look at websites that condense that information for you. You can do something very similar in the natural gas futures market. And the U.S. Commodities and Futures Trading Commission, they condense things for you via their commitment of traders report. This breaks down open interest by type of market participants, including hedgers and speculators. Now, the speculators, or the non-commercials as they're also known, these are considered to be the so-called smart money because they spend considerable time and resources predicting in which way the market may be headed. Now, I say smart money in air quotes because they aren't always right. But just know that these are companies that are trying to make a living by predicting and trading on price movements. Anyway, the theory goes that the more net long speculators are, the more they believe futures prices will rise and vice versa. Since these data are produced by the U.S. government, they are publicly available. So that's a great resource potentially. And by the way, we also run these data in our daily gas price index service. The other source for me to talk about today, options prices. Now, this is going to be a little bit more of a complex discussion because options, by their very nature, they are complex. But I'll keep this as simple as I can. Just know that options prices can actually yield some very useful clues about the future volatility of natural gas futures prices. And as a quick background, and again, I apologize in advance to all the options traders out there, options can either be calls or puts. Calls give you the right to buy at a stated price within a certain amount of time, and puts give you the right to sell at a stated price within a certain amount of time. I always like to think of this as buying and selling a rock. If you buy a rock, you call it from their pocket into yours. If you sell a rock, you put it into their pocket. Anyway, you can get an idea of whether the market is anticipating more or less Henry Hub futures price volatility based on how option premiums change over time, particularly at the money options, or option contracts with a strike price that is close to the actual underlying futures contract. Why at the money options? Why not other options? Why at the money? Because those at the money options basically have no intrinsic value or how much in the money an option is. For example, a call option to buy gas at $7 when the market is $8 is obviously worth no less than $1. And this intrinsic value, it's a key component in the famous Black-Scholes option pricing model. For this exercise, we actually want to focus on the other things in that model. So using at-the-money options prices basically eliminates the intrinsic value portion of it. Now, maybe not quite to the exact penny as far as the actual math goes, because unless the actual underlying price is exactly the same as the strike exercise prices, there could still be a bit of intrinsic value left in there. But just know for this exercise, it's certainly close enough. Now, know that the price of both call and put options should go down over time as they get closer to expiration, which in options parlance, it's known as theta. So, given that, if you see that at the money options premium for a particular delivery month for natural gas are rising over time, this is most likely a result of Vega, or an increase in expected futures price volatility. Now, look, it could also be because of the other factor, Rho, or changes in interest rates. And certainly, we've seen some impact so far from this in 2022 in the United States. But longer term, we believe volatility or Vega trends, they tend to have a much bigger impact on Henry Hub option prices. Greater volatility makes the value of both calls and puts increase. So really, you could monitor movements in one or the other over time and get similar results. Anyway, just tracking at the money options premium over time, we believe it certainly can serve as a very quick and relatively straightforward method to monitor a potential change in Henry Hub futures price volatility. Now, just one quick caveat to this is that the closer an option gets to expiring, the more that theta or time decay portion will take over as the main impact on options pricing. But this tends to be greatest towards the very last few days before a particular option expires. So we believe tracking Vega tends to be a pretty darn good indicator for the majority of the life of an option. That's really all I have for today. And again, this does conclude our three-part series. Thank you, as always, for tuning in today. And if you like this particular episode, we kindly ask that you forward to others who may find it useful. I wish you health and happiness and very much look forward to speaking with you again. Take care.